Breedon is one of the biggest and most successful construction materials companies in the country. Its aggregates business, for one, is highly cash generative with high barriers to entry, and the firm as a whole has been a solid performer over the long term. The shares have been on a downward path since the summer, but there are still plenty of reasons to be positive. In November, Breedon spelled out the next chapter of growth, including how revenue would outperform its markets. The outlook for infrastructure spending is also encouraging, especially among aggregates-intensive construction projects like highways. The UK government alone plans to spend hundreds of billions of pounds on public infrastructure by 2025. Breedon has just paid its first dividend and is committed to a progressive dividend policy. The share's valuation is also near the bottom of its historical range. Building a portfolio of successful service businesses using a franchise model has been rewarding for AIM Company franchise brands. Its brands include Metro Rod, Willow Pumps, Metro Plumb, Chips Away, Oven Clean, Barking Mad, Azura Group, and the Handyman van. There's already been a positive response to its recent update, in which management referred to a continuation of its robust growth trajectory. The city expects profit to have grown by over 20% in 2021, and strong cash generation underpins optimism about the year ahead. Profits tipped to grow by strong double digits again in 2022, but there could be room for upgrades to estimates if the company keeps up this performance. Running Indian call centres and supplying back-office outsourcing systems has been a lucrative business for iEnergizer. In November last year, the company, which is listed on the AIM market, published record first half results and increased its dividend by 40% to reflect a similar increase in pre-tax profit. Highlights of those results included profitable revenue growth and sustained margin improvements, which management attributed to growth in new customers and deepening existing customer relationships. It also keeps a close eye on costs. Those numbers are a good indicator of the confidence management has in its growth strategy and outlook for the year ending 31st of March 2022. iEnergizer is not a high-profile company and clearly hasn't appeared on the radar of many investors, but consistent performance warrants a closer look. Diversified Energy Company, which traded as Diversified Gas and Oil when I tipped it in 2021, did exactly what it was meant to do, delivering a whopping dividend yield of 10.3%. Yes, the share price eased by 6%, but Diversified is one to own again in 2022. Its name has changed, but not much else. High margins are the big focus for this gas and oil production company, which operates in the Appalachian Basin in the United States. Big profits demonstrated an ability to generate significant cash flow, which underpinned another dividend increase in October. It's also able to reduce debt and fund growth. And CEO Rusty Hutson remains committed to returning cash to shareholders, offering a chance to generate a double-digit income in the year ahead. Investment giant M&G was another of my successful income tips for 2021. And the trawl of the UK market in 2022 reveals very few dividends that even come close to M&G's prospective yield of 8.5%. A strong balance sheet underpins both a payout that beats rivals and puts M&G in a good position to exceed its capital generation target of 2.2 billion for 2020-22. There's execution risks in some areas, true, but M&G paid out last year despite serious doubts. M&G shares briefly touched pre-COVID share prices last year and, after falling back, are on the rise again. I believe this is one income stock to keep in your portfolio. House builders have featured among the UK's top dividend payers for a number of years, and I think the country's largest house builder is one for income seekers to consider in 2022. Concerns about a range of issues have caused a decline in share price of over 20% since last spring. They're currently as cheap as they've been for a year. Damaging sentiment are fears about the strength of the housing market, rising costs, supplies, and staff shortages. However, those fears look overdone, and higher build completions and average sale prices were highlights of its recent trading update. Persimmon has already promised to pay back 125p to shareholders this summer, giving a dividend yield of almost 5% at the current share price. But surplus capital will also be returned separately in the spring, turbocharging the payout.